But the S&P 500 crashed just 3 years ago. It fell 27% at one point in 2022. But it wasn't like this. In 2022, the sell-off was fairly slow, with stocks getting sold piece by piece from January to October. This time, the selling is quick. It's one of the fastest falls since COVID first hit, and before that, the subprime crisis. So let's talk about all this, where it goes and what's really going on with Anderson Capital Management CIO Peter Anderson and Oppenheimer Head of Technical Analysis, Ari Wald. Peter, I'm going to start with you. It's easy to forget that in 2022, the markets fell 25% because it was kind of slow and, dare I say, orderly. This feels different. What are you advising your clients to do right now?
Well, of course, it feels very different because, it was simpler then. I hate to say that. It was very painful, but it was simpler because we were all focused on one thing, the Fed raising rates. That was the theme for the year. This year, too many variables, too little visibility. Clients are asking, what the heck should we do? And I would say, will we be talking about this 6 months from now? We're hoping that this will all be resolved in 6 months. If you are still happy with your equities and you can logically defend it, I would say, if you can, stay the course.
Well, I would say, Peter, what if it's not resolved? Everybody, you're right, kind of keeps waiting. It's a negotiating tactic, art of the deal. What if it's not resolved, Peter? What if we're still talking about this in June and July and August?
Yeah,
what then?
Well, we still could be talking about it, and not that it will be totally resolved, but we should get some clarity. I mean, if this pressure continues, everybody in the administration, so far they've been pretty much mute about this reacting to the markets. But my sense is at that point, there will be some kind of acquiescence or giving in or changing course, because we know that the administration takes a very serious read on equity markets, almost in a vanity sense.
Ari, jump in here, especially as we mentioned a second ago, we're getting back to almost the lows of around 4,900 on the S&P. Technically speaking, does that interest you?
In terms of levels and durations, how we think of these setbacks. First off, let's go back to 2022. In hindsight, it was short and orderly. Rest assured, we were all scared. You turn on all these financial broadcasts. There was no more certainty than there is the uncertainty now. People were worried about runaway inflation. The point being, we've seen this before. We've seen these declines. They all play out the same way. And I think that how we're thinking about it is that we've suffered kind of what you would typically suffer over a 7-month time period and only 2-month time period. And what that argues for is that we need more time. I don't think this is through just yet. But with that said, there's going to be ebbs and flows along the way. I think April 7th, that was the high intensity low. At least that's the point when I think a lot of stocks bottom, when downside acceleration is greatest. Typically what happens next, you get a test of that low. You're going to be looking for signs that selling is becoming less bad. The VIX isn't going to be as high as it was. And that sets the stage for the counter trend rally that I think we could see into the summer. I think that 200-day average is going to limit upside. And I think, again, thinking longer term, we're not out of the woods just yet, that there's going to be additional volatility shocks in 2025.